First of all, I'm delighted to be here. The two Bens, I think, are heroes. They're very aspirational people for what they're doing, and I'm amazed and delighted that so many of you are actually interested in the subject of money, especially the way the positive money movement is presenting things. I really truly believe this is as an important issue as the issues of 2 centuries ago, the abolition of slavery, the Corn Law reforms. I think if we get true reform in this country on monetary matters, it will go down in history as that magnitude of importance. Anyway, Ben asked me to come here to explain what I would do to reform the money system and what my particular take on solutions are, which are slightly different to Ben's. There'll be, in some ways, a critique of his, so fair play to him for inviting me as well. But we have a lot of commonality, and I think just speaking to Professor Mary down there, I think we have an agreement on the problem and the end point, and probably disagreements about how we get there. Anyway, the first slide here, I thought we're going to start with a little recap of what money is. You may find it tedious, so I apologise, but just for some people, I know some people are absolutely amazed at the wizardry that goes on in money creation, so it's always worthwhile having a little recap. And then for the two Bens, I've put a little quote here that I thought they might find amusing. When you're 1 step ahead of the crowd, you're a genius. When you're 2 steps ahead of the crowd, you're a crackpot. And now, unfortunately, I think at the moment we're all in the crackpot camp as far as the mainstream economists and the press and all the opinion formers are concerned. But I can tell you one thing: with all these great reforms that happen in history, day 1 you're a wide-eyed loony. Day 2 you're theoretically robust, and of course, yes, it could all happen, but you're so impractical and so on and so forth. And then in the third stage, you are a genius, but of course the person doing the implementation of the reform knew it all along, thought of it all themselves, and then does it themselves. So I suspect we'll be in that category. But anyway, what money is and is not. So we are all familiar with this little part of the money supply, the 3%, the tiny weeny bit right at the bottom, the cash and the notes and coins. To some people, it comes as a great surprise that there aren't any more cash and notes and coins. There are a significant amount of, just first of all, I've capped the money supply at 2 trillion. I think at the moment, last time I looked at the Bank of England balance sheet, it was 2.1 something. But for the sake of round numbers, it's 2 trillion. And it's made up of cash, notes and coins, bank IOUs, which are demand deposits. Now, I don't know whether everyone is happy with the terminology of a bank IOU. Does everyone understand here the money creation process? I don't know, Ben, you're happy that if you put a deposit in a bank account, say if you put your salary into the bank account, it's then a small reserve cash is kept at the bank. It's then lent out to an entrepreneur who may well then bank in another bank, and before you know it, you've got 2 claims equally valid to the same pot of money, and in fact that happens 33 times on average in the economy. And really, all of that is just bank journal entries in bank books, and your bank statement is nothing more than a journal entry. There's no cash really behind it except for that 3%. And you trade your bank journal entries every time you do a transaction from that account, where you make a check or a direct debit or a standing order. Is everyone comfortable with that, or does anyone want me to go through that process? I think that means we're comfortable with that. Time deposits. This is where you put your cash in, and then it's lent out on a timed basis to borrowers who could be entrepreneurs, who could be householders having mortgages and so on and so forth. And that's where your money gets put away for a period of time. So it can't be multiple on-ended. It only gets lent once in the time deposit structure. IOUs is where all the naughtiness happens. So, for the sake of what I'm going to talk about, time deposits look after themselves and cash looks after itself. That's all honest. Cash is honest. Those time deposits are honest. This is the bit I find dishonest. So we're going to just deal with this little section, bank IOUs. Now, I don't know, you would think in the 21st century it would be possible to count money. Economists have great disputes over this, and that little thing of cost of coffee here, may I pick this up? Right. We can count that, and we can probably count all the cost of coffee things branded like that size around the world. Difficult, tedious task, but it can be done. Why can't we count money? So I've thought a lot about why we can't count money, and you have to go back to really the thought processes behind what is money. Now, money to me is the final goods for which all things exchange. That's Carl Menger's definition. I'm very happy and I'm very comfortable with that. And if you always bear that in mind when you're thinking about the concept of money and how to count money, you can actually come up with remarkably different measures than the official measures. Notes and coins, where's that line there, the red line there. Notes and coins is a nice easy thing even the government and the central bank can count, and they do get it accurate. Now, notes and coins aren't the only thing that's the final means for which all things exchange. So those those demand deposits are things that we can exchange for other goods and services. I can go into WH Smith's and I can write a cheque out for a newspaper and I can receive the newspaper. Therefore, those time deposits, those bank IOUs, function as money. Now, that is essentially my measure of money, actual money supply, which is this blue line. Okay? And the other government official measure of money, which counts money incorrectly, is N4, which is this green line. And that includes all the time deposits. And of course, you think about the nature of a time deposit. If I've lent my money to someone, in the form of a time deposit, I can't go into WH Smith and say, here's my savings book, can I buy a newspaper please? Because the man at the till will say to me, no sir, I can't accept your savings book in exchange for a newspaper. I need to have money, so you then either give him notes and coins, the thing at the very bottom, or you give him a bank IOU. You exchange via your bank account. So methodologically, we need to root ourselves on a firm definition of what money is to then understand how we can affect reform in the money movement. Now, I think I with my colleague Professor Anthony Evans at the European School of Management, if any of you are ever interested in going into the theoretical study behind these figures, there's a little a link to where it sits on the Social Science Research Network, and it's in the top 10 downloads on all money papers in the Social Science Research Network. We're getting a lot of positive feedback from it. And even the Bank of England have graciously accepted that they might consider using it as an alternative official measure. They'll never accept that of course they're theoretically wrong. When you have money actual, just show you some things you can understand and do with it. The quantity theory of money will tell us, and I think there are some truths in the quantity theory of money, that the money should ultimately equal up with the price level. There should be a relationship between the two. So my measure, actual money supply, stripping out the demand deposits, the time deposits, and various other bits and pieces in there, shows how from 1998 to 2001, some of you may well remember, some of the older ones in here may remember, the dot-com boom, long-term capital management disaster there in 98, dot-com boom, the bust, then the trying to reflate, the messing around, and then this is 6 months or something before Lehman Brothers, and then bang, the crash to fall off the edge of the cliff. I knew about that before it was going to happen, because I've known about a lot of these things. And then the start of the recovery. And my data, I can't remember when I did this. When did I do this? At the beginning of the year. I'm sorry for not updating it then and then. But to let you know, there's a sort of ziggy-zaggy bottoming along, running along the bottom here. So we're becoming more stabilised at the moment, according to my money measure. So you have to have a theoretically robust measure of money. That's it tracked against industrial production. I think you can see it's more useful than the data they'll give you at any economics course that you do. Right. So, some other observations that I make. I owe you bank money. Those demand deposits, they can only exist with the following things in place. They wouldn't exist in an unhampered and a free market where freely consenting adults transact with each other. A central bank acting as a lender of last resort needs to be there. And that's because if you have a situation like today, if more than 1 in 33 people on average walk into specific banks and demand redemption in cash, then they ain't got the money. Yeah? So what do? They have to go to the big daddy, lender of last resort, the central bank, and they have to get an overnight loan on discount window to fulfill their redemptions. So that multiplication of credit cannot exist in an unhampered market, and it can only exist in a market where the state has put a large intervention in there, and the principal intervention being the lender of last resort, the central bank. Publicly funded deposit guarantee schemes to protect depositors is an entirely rational thing for depositors to ask for. I don't agree with them at all, but in a fractional reserve banking environment, of course you have a rational fear that the whole system will go bust because it's fundamentally unstable. Just on a side, banks are the only companies in the entire universe that are allowed to exist on a fractional reserve ratio basis. All the companies I own, if I cannot provide for my creditors, for my current creditors, and for my long-term creditors, then I am insolvent, and I must wind the company up instantaneously, or run the risk of going to prison. Banks have a special legal privilege to trade on a fractional reserve, which means they cannot, at any point in time, ever redeem all their promises. It's thoroughly dishonest. And so we are entirely rational with a system that's got a big intervention in it to want to have deposit insurance. And for this whole system to work, there must be large-scale regulation. There must be large-scale regulation to try and control all of this system, because none of the disciplines of customer and supplier that exist in all other businesses except banks are allowed to exist. And there's an assumption now that everything in banking is too big to fail. So, if you're a banker, you can do anything you like. It's not going to implode the world system. Well, it's going to be bailed out. Who cares? Yeah.